approach. Capital budgeting analysis, MBA finance for. In today's video, we'll discuss an important capital budgeting decision, whether a company should buy or lease an asset for expansion. This is a very common practical financial management problem, especially relevant for MBA finance students, professionals, and competitive exam aspirants. We will solve the problem using the net present value method, that is NPV method, and by the end of this video, you will clearly understand which option is financially better, buying or leasing. This is the problem. This is the problem. I am not reading the problem. It will take unnecessary time. You can check, but I am briefing the problem in my next slides. Okay. Decision overview. Company planning for expansion. Option 1, purchase the asset. Option 2, lease the asset. Evaluation method, net present value, that is NPV method. And this is the brief of the problem. Buying, option, key data. If you read the problem, if you read this problem, and the data has been summarized here. Buying, option. Cost of the asset, rupees 2,05,000. Sorry, cost of the asset, rupees 2,500. Life, 5 years. Salvage value, rupees 500. Depreciation method, straight line method. Tax rate, 50%. Cost of capital, 10%. This is the key data for buying option. Okay. Now, depreciation calculation. It is a straight line method. That's why cost of the asset minus salvage value divided by life. Cost 2,500 minus salvage value rupees 500 divided 5. That is rupees 400 per year. Depreciation. Okay. Now, buying option, annual cash flow. To calculate NPV, cash flow is required. How to calculate? Revenue is 1,500 rupees. Expenses rupees 700. Depreciation I have just calculated rupees 400. That's why profit before tax will be 400. 1,500 minus 700, that means how much? 800 minus 400 depreciation. But I have shown the calculation in the Excel sheet also at the last of all slides. Okay. Tax rate is 50%. That means tax will be 50% of 400, rupees 200. That's why cash flow will be profit after tax plus depreciation. That is 200 plus 400 is 600 per year. Okay. This is buying option and this is the cash flow per year. Next. Now, buying option NPV calculation. Present value of 600, rupees 600 for 5 years at the rate of 10% discount rate will be approximately rupees 2,275. I will show the calculation in detail also through Excel sheet. You can check it also. The present value of salvage value, that is the last year, the salvage value whose present value is rupees 310. The total present value, this plus this, that is 2,585, and initial cost is 2,500. That's why NPV is rupees 85. This is rupees 85 for the buying option. This is the net present value. As it is positive, that's why the decision can be taken, can be accepted. But which one is better? For that, we also have to calculate the leasing option. Lease rent per annum is rupees 650. This is the expense. And revenue per annum, it is given in the problem rupees 1,500 per year. Then operating expenses is given rupees 600 per year. Okay. And tax rate is 50% and discount rate 10%. Here it is not required to calculate depreciation, as lease means not the owner of the asset. So these are the key data. Now how the computation is made? Profit before tax will be the revenue minus operating expenses minus lease rent. That is 250 rupees, 250 per annum would be the profit before tax. Tax is to be charged on this amount. That is 50%. Tax, that is 120. This profit after tax will be 125 and annual cash flows will be 125 rupees. Then what is the NPV for this leasing option? The present value of 125 for 5 years life of the asset at the rate of 10%. If you discount the whole revenue, approximately it will be rupees. This is rupees 474. I will show the calculation through Excel sheet again. No initial investment in this case, because for leasing option no investment is required. That's why NPV is 474. Now comparison and decision. Net present value for buying option is rupees 85 and net present value for leasing option is 475. So as this amount is higher than 85, that's why the investor should go for the leasing option. Decision is select the leasing option. Okay. Next, discussion for question. If the corporate tax rate is reduced from 50% to 30%, say, or it may be 25, whatever it may be, would the buying option become more attractive? Would leasing still remaining the superior? How would the depreciation tax shield change? What happens to after tax cash flows? Analyze using the NPV framework. These are the topics for discussion relating to this problem. Okay. Now, what are the key learnings? Key learnings: use NPV for capital budgeting decision. Consider tax impact and depreciation shield. This is the key points. Compare present values of alternatives. Select option with the higher NPV. All these are the key points. Now I am going to show you the calculation sheet. See, this is the calculation sheet. First, computation of buying. The revenue for each year is noted here, first year, second year, like that, and expense for every year same 700. If it is different, you can write different if the expense is different years. Depreciation, I have already shown the 400 rupees 400 per year depreciation charge SL method, and it is done here. That's why profit before tax is computed. Is revenue minus this is the formula. C5 is this revenue minus D5 plus C5. This is depreciation plus expense. This is profit before tax that I have discussed in my previous slides. And tax charge will be at the rate of 50%. That's why here is a formula also given. You can check it into 50%, rupees 200. This is for profit after tax, and this minus this formula is given here. You can check the formula from Excel sheet also. And this is the profit after tax, and cash flow is profit after tax plus depreciation. That's why the formula is E5 plus I5. You see, E5 means the depreciation plus I5. I5 is the profit after tax cash flows. And what is the present value? The discount factor after 1 year is at the rate of 10%, 0.9091. If you multiply this with this, you will get the present value. This in this way, I have just copied the formula. So you will get the present value for all the years. Discount rate is given for the appropriate year. Say this is the discount rate after 4th year. The formula is given here: 1 by 1 plus 0.2 to the power 4. As it is 4th year, that's why in this way discount factor is calculated. And finally, scrap value amount is receiving at the end of 5 year, 5th year. That's why this 500 is noted here. And the discount factor is this and this same, and this is the present value factor. And the total present value is 2585, which I have already mentioned in my previous slide. Less cost of the asset, that is initial investment 2500, and the net present value, the surplus is 85 rupees. In this way, for buying option, we can find out the net present value. Now I am showing the leasing option. In the case of leasing option, first year the revenue is 1500 and expenses 600. 620 is lease rent. These are revenue expenses, and the profit before tax is this minus this and minus this. That means you can see the formula: C18 minus C18 means this minus this plus this total, and this is the profit before tax. And tax rate is 50%. That's why this is the 50% tax rate is given, and it will be 125. And profit after tax is this, and this is the cash flows also, because there is no depreciation. That's why we are not adding anything. And the present value if we multiply the discount factor, this is the first year discount factor, this multiplied by this, then you will get the present value. You can check through the formula also. For every year I am noted here, and finally the total cash flows, total present value of the cash flows will be 474 rupees, and this cash flows for buying and this is the cash flows for leasing, and this is higher, that's why the decision will be to invest for leasing. Okay, this is the calculation part. One question was that if the tax rate is changes, if the tax rate is instead of 50%, if it is 30%, then what will happen? What you will do, I am showing from this Excel sheet also. Just everything remains same, other things remain same, only the tax percentage is being changed. That's why 0.5 in place of 0.5, just I am writing 30%, and you just copy all the, and this is the tax, and accordingly automatically profit after tax has been changed, and you can check because formula is given, that's why entire calculation has been done, and the net present value for buying option is 384. And if we change the tax rate for here also 0.3, then what will be the total NPV? You can check. 75 is the tax. Now just I am going to copy it for 5 years. You can check 663. Again the net present value for NPV for the leasing option is higher than buying option. That's why you should go for the leasing option. Okay, for 30% tax rate also. You can change the revenue portion also, cost also, just in Excel sheet you change the value, then you will get the answer. Okay, now again we are going back to our original. I am not saving it, that's why I don't save. Now calculation part is over. I have shown the calculation. Now scope for future video, I have mentioned here. Another option, buying the asset through long-term loan may be incorporated. We have not taken that option. That means we can purchase, buy the asset by taking long-term loan also. Then what will be the effect? That means in that case the problem will be you should go for purchase or buy the asset by your own fund, or you should take or borrow long-term loan and buy the asset from the loan and your partly your own component, own part, and the leasing, which is the best. That I have not shown here. The video will be unnecessarily lengthy. That's why I will show it in my different video. Okay, thank you. If you like the video, please give like also, and if you have any comments, please mention in the comment box. I will definitely reply for it. Or please, you can share the video to your friends also. Thank you very much.